Money FM 89.3, the best of your money. Money and Me on Your Money, only on Money FM 89.3.
Earnings season so far off to a positive start. 64% of S&P 500 companies have reported results. Markets wrapped their busiest week for Q3 earnings last week, highlighted by results from 5 of the Magnificent 7. Microsoft, Alphabet, Meta, Apple, Amazon. Are investors satisfied, and how have markets responded? Well, meanwhile, we'll also switch gears and look at the Federal Reserve, which delivered that widely expected 25 basis point cut, bringing the benchmark rate to a range of 3.75 to 4%. But Chair Jerome Powell has signaled that a December cut is far from a done deal, stressing caution over inflation. And with the U.S. and China agreeing to a one-year trade truce, who walked away stronger? I'll put these key market themes to Simon Ree, founder of the Tao of Trading, who, by the way, is going to host a mastermind here in Singapore, December 6th and 7th, right?
That's right, Michelle.
Fantastic to have you with us. Good morning.
Good morning.
So, first up, I'm excited. What happens during a mastermind?
So this is 2 days with me live in the room, where really what we're trying to do is condense 30 years of market learning and experience into 2 days.
Oh my gosh.
Now, online programs are great at educating and teaching. Mastermind is all about transformation. It's about coalescing all of that information and walking out with the confidence to execute a plan for 2026 that you just can't wait to put into place.
And you've got a discount happening.
We have. So for anyone who books between now and 4 p.m. tomorrow, they get a $1,000 early bird discount.
Hey, you heard it right here on Your Money. Fantastic. We love discounts. And we'll get a little bit more into the mastermind a little later. I'd like to know, who it's for and what sort of experience you'll need to benefit from 2 days with you. But first, let's start with earnings week and market reaction. So 5 of the Mag 7 members with a combined market value of over 15 trillion reported results. The tech titans, Apple, Microsoft, Alphabet, Google, Amazon, and Meta reported better than expected results from across the board, and they also forecast massive investments in AI to grow in the coming year. So how has the market actually responded to these mega cap results so far?
So far, market reaction has been positive. The most positive was Amazon. The stock shot up 9% after results. AWS clearly beating expectations and very positive guidance. We had Microsoft dipped a little. Google was up a little. Apple was about flat. Really, the only disappointment was Meta, and that was more due to a large one-off non-cash item related to a tax change. But it decimated their earnings for the quarter, and the market sort of seemed to get a little bit freaked out by that. Meta stock was down about 11%, but their earnings actually look pretty okay.
Are we seeing real earnings strength across these 5, or is this an AI-fueled sort of optimistic wave keeping valuations high?
It's a little bit of both. I mean, there's no question we are seeing very, very strong earnings. Revenue is strong, income is strong, free cash flow generation is strong. All of that looks great. Alarming's too strong a word, but one thing I'm watching is as a group, they're looking to spend more than $1 trillion a year on capital expenditure, AI CapEx. Now, so far, the market isn't asking any really tough questions about that. But this money is still losing money. It's not making money. And the market's only going to have a certain amount of patience for that. All right? You can't infinitely fund this level of CapEx without one day earning some sort of return on that CapEx.
Great theme to look out for. What other signals from the tech giants' forward guidance is standing out to you, particularly around maybe cloud profitability?
Well, cloud profitability, it's you look at players like AWS and Google Cloud, and they're enormously profitable, but they're entrenched players. Microsoft Azure is the other one. What concerns me a little bit more is companies like Oracle, who are kind of a little bit late to the cloud game, and they're really competing on price. Now, their shares got a big lift a month ago, or a few weeks ago, when they announced $380 billion worth of orders, right, forward orders for cloud services. Now, the Wall Street Journal revealed that $300 billion of that is coming from OpenAI. Now, OpenAI is a company who did $4 billion worth of revenue in the first 6 months of this year and is still making a loss. All right, so how are they going to fund $300 billion of AI investment? The arithmetic is not clear to me.
So Apple, Microsoft, both hovering near that $4 trillion valuation mark. NVIDIA not far behind. Do you think they can hold on to that status, or is there a risk of re-rating once maybe earnings growth normalizes?
Look, I think right now we're in a spot where earnings, cash flow is all positive, and like I said, the market is still not really scrutinising these AI CapEx figures. The market hasn't started asking the tough questions. And I think until it does, this train can continue. Now, these stocks are not on sale, all right? They do not look cheap. And if you look at the S&P 500 as a whole, price to sales now is actually higher than it was at the peak of the Dotcom boom in 2000. So, yeah, stocks are not on sale here, but the momentum is still positive, and I think it will remain positive until the market starts saying, hang on a minute, you're going to spend how much on this stuff that you're still not making any money from?
So how sustainable are these high valuations in your book for these dominant tech players?
Like, I think ultimately cash flow has got to catch up with the story. And it doesn't show any signs of doing that yet. So one of two things has got to happen. Either the AI money that they're investing starts earning a return on investment, or the valuations drop to kind of come back to reality. So we've really got to watch, and it's going to be a quarter-by-quarter thing. If we do start to see AI investments earning a positive return on investment, the economics of cloud and AI could get rewritten. But if we don't see that, there's a significant valuation gap there that may need to be filled.
So right now, though, is the market showing any early signs of AI fatigue in valuations, or are investors still in this fear of missing out mode? Yeah,
I think FOMO is the stronger driver here, for sure.
Stronger driver. All right. Any final words on earnings weeks and market reaction so far?
Well, so far it's been good. As you said, 64% of the S&P 500 have reported. So we're more than halfway through the earnings season. Really, the beat rates are white hot. 83% of companies have reported earnings better than expected. That's well above the long-term average of 75%. Now, the beats have been slightly smaller than expected. The beat rate is on average 5.3%. Versus the long-term average of 7%. But just given how many companies are beating expectations, and look, the bar isn't low here. Expectations were already quite lofty.
Yep.
I would say that there's really no concerns on the immediate horizon regarding earnings.
All right. So let's talk a little bit about the Fed and the future rate trajectory. Are you seeing any clues or language from Powell that you're watching for?
So Powell, I mean, the FOMC statement was as expected. I think the press conference was a lot more hawkish than people were expecting, because he emphasised 3 or 4 times a rate cut in December is not a done deal. Now, you might expect the market might have reacted a little negatively to that, but I think there's a couple of other things happening. One, the market is potentially looking through Powell, saying, well, this guy's not going to be here in 6 months, and then when Trump's new guy gets the job, we'll get all the rate cuts we want. All right, the second thing that's happening that is more dovish is quantitative tightening is coming to an end. All right, and it's happening at arguably just the right time, because bank reserves are at a 5-year low. So liquidity is certainly starting to tighten up in the banking sector.
And how do you see this shift playing out for equity markets that already appear priced for perfection?
Well, if we're getting an end of QT, that should be a tailwind for equities. And if we are going to get more rate cuts, that should also be a tailwind for equities as well. But if we do start to see a re-emergence of inflation, that could be a negative, because generally that is going to mean the central bank is going to tap the brakes on further liquidity provision.
At what point do you see risk appetite snapping back to reality, if at all, in this cycle?
Yeah, I think it's really going to come down to scrutiny over AI CapEx spending. Like I said, as a group, if you look at AI as a sector, it represents about 42% of S&P 500 market cap. The concentration's kind of ridiculous. And they are spending as a group more than $1 trillion a year. All right, so that's a lot of GDP is being generated by AI spending. But again, if that money doesn't make money, we really could see these stocks get put on ice. Now, I'm not saying that AI is a fad or AI is never going to make money, but bubbles always happen the same way, right? You front load the investment, but the monetization is very back end loaded. And the same thing happened in the Dotcom boom and bust. There was an enormous amount of CapEx spent on telco rollouts and fiber optic cable rollouts. And it's not, the AI, the dot-com bust didn't happen because the internet was a fad. It just happened because of the timing mismatch between the build-out of the infrastructure and when that infrastructure actually started to make money. And I think a similar thing could happen this time round.
Yeah. There is another round of US-China trade talks scheduled for Friday, and we've seen both sides sort of tone down rhetoric recently. Any meaningful outcomes likely, or is this about optics more than substance?
Look, I think the market has already had the key uncertainties resolved. So the big one was around rare earth exports from China. China has agreed that they will suspend new rare earth export controls. They're also going to take significant measures to stem the flow of fentanyl to the US, which obviously makes Trump very happy. And they've also agreed to purchase at least 12 million tonnes of soybeans from the US, which makes for a great headline until you realise that's actually half what they bought last year. So out of the deal, you create a crisis and then you solve it with something that is worse than what you had last year anyway. But the US will reduce tariffs on China by 10%, and they'll extend the Section 301 tariff exclusions by another 12 months. So I think the key uncertainties have been resolved, and certainly we see US futures trading slightly green.
With these key uncertainties resolved, do you think this is going to, how could this influence investor sentiment or supply chain related sectors?
Well, I think it relieves a key geopolitical uncertainty. The market clearly doesn't like it when trade tensions get ratcheted higher, and anything that can be done to kind of remove the grit from the cogs of global trade, I think is a positive. So this is a decent step in the right direction.
Simon Rees, my guest. He is founder of the Tao of Trading. Let's talk about all that glitters. Is gold losing its shine or catching its breath? It's recently pulled back from recent highs. Simon, has the fear trade truly cooled, or is this just another consolidation until a higher move?
I think it's just a consolidation, but it wouldn't surprise me if gold kind of chills out here and does nothing for a little while. When I was in the studio last time, we talked about how gold was a very crowded trade. All right, we saw in the Commitment of Traders report speculative positioning was the most long since at least 2016. And I said, look, the trend is bullish, but this is a crowded trade here. Now, since then, gold's pulled back 10%. Like nothing cataclysmic, but that's just what can happen when, quote unquote, everybody's long. All right, when everyone's long, a market runs out of buyers. When a market runs out of buyers in the short term, it can just fall under its own weight. What we're seeing, though, is we saw another quarter where central banks globally, they accumulated another 220 tonnes of gold. This will make 2025 is on track to be the fourth consecutive year where 1,000 tonnes of gold, at least 1,000 tonnes of gold have been accumulated by global central banks. Now, this trend started in 2022, right, which is when the US started weaponizing the US dollar with the confiscation of Russian US assets. And this was a big wake-up call, I think, for global reserve managers that, hey, we need more gold in our reserves. All right, this is part of the very long-term process that gets talked about, de-dollarization, which is happening, albeit very, very slowly. But I don't think that trend is about to stop and reverse.
On my trip to the US, I narrowly missed out heading to Fort Knox to check to see if all that gold was there.
You conduct your audit. Yeah, well, the world's still waiting on the Fort Knox gold audit.
I will get there eventually.
I wonder.
How do you see gold positioning in a world where rate cuts resume and fiscal deficits remain massive?
Well, actually, the question on positioning is an interesting one. We haven't seen an update on positioning since September with the government shutdown. All right, because the CFTC is responsible for producing the Commitment of Traders report, which is the gold standard, pardon the pun, to track speculative positioning. But yeah, look, I think gold
we just don't know.
We don't know what speculative positioning looks like. But I think in a world where reserve diversification is something that's being seen as very necessary, interest in gold isn't likely to die down.
All right, we've been hearing more about fiscal dominance, the idea that government borrowing now drives central bank decisions. Can you share a little about, is this a part of the narrative that you have your eye on, and why would this matter for traders?
It matters for traders because fiscal dominance really impacts the independence of central banks. Now, people might mock the idea that the Fed is independent, but the fact is, if you've got a situation where the government has kind of explicit control over interest rates, it actually does put the world in a very, the global financial system in a very different situation. If Trump has got explicit control, or whoever succeeds Trump as well has got explicit control over interest rates, it means government debt is only going to go one way, all right, because they can control the funding cost of it. Now, the bond market might have a fit if that happens. You might see bond yields really start to soar. The government would counter that by just issuing more and more and more short-term debt where they do have more control over the rates. But if you've got bond yields surging to 6, 7, 8, 9%, whatever the number is, it's going to suck the life out of a lot of other asset classes. People are going to say, well, if I can get 8% on a bond, why do I want to take the risk on equities?
Love the way you explain things. Always makes so much sense when Simon sits us down and talks us through these concepts. So looking forward to your Tao of Trading Mastermind happening December 6th to 7th here in Singapore. And this is your first in-person event for a while?
It is. So it's the first one we've done in person. Really excited about it. I mean, like I said, it's 2 days, but the pacing is strategic. We've got coffee breaks morning and afternoon, lovely gourmet lunch at the Straits Kitchen both days. And it's going to be very dynamic. We've got giveaways, we've got prizes, we've got live auction, we've got some hot seat coaching.
Live auction?
Yeah. We've got a live auction experiment as well.
With real money?
Fun. Yes, indeed.
Okay, great.
So it's going to be very interactive. It's going to be very audience-led, audience-driven. It's going to be a high-energy event, and it'll suit traders of all levels. I mean, if you're just starting out, this will get you on the right track from the very beginning. So hopefully you won't make all the mistakes I made in my early years. And if you're a seasoned trader, this is just going to help you refine your edge, redefine what you're capable of, and like I say, walk into 2026 with a rock-solid trading plan you can't wait to execute.
Oh, I love the sound of that. So even if you're taking baby steps, this is for you? You don't have to feel intimidated with this crowd?
I can't think of a better way to get started. You're going to get started on the right track, hopefully avoiding all of the bad habits and mistakes that plague so many other beginning traders. So
given this market backdrop of AI-fueled momentum, still macro uncertainty, what trading edge will you help traders develop?
So 80% of good trading is good risk management. All right, so we're going to really incorporate that into the trading plan. And then 80% of finding good trading setups is good trend identification. So it's going to be making sure that you've refined your edges, you learn how to identify trends, and you learn, more importantly, how to exploit them for profit.
Really excited. And thanks so much for giving listeners a discount as well. It's $1,000 till 4 p.m. tomorrow. And where can they get their tickets? $1,000 off.
$1,000 off, that's right. Yeah. Tickets are available at taoiftrading.com/Singapore 2025.
Oh, I really appreciate you sharing all your insights with us here on the show as you have over the years. So looking forward to seeing more about this mastermind and perhaps stepping into the room myself, Simon. Thanks for being here.
Be lovely to see you there, Michelle. Thank you.
Simon Ree there from the Tao of Trading, and you can find out more about his Singapore Mastermind Live happening December 6th and 7th at his website.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.
Money FM 89.3